Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star zero. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thank you, operator. Hi, everyone. It's Nick Hamilton here with David Burrows. Thanks for dialing in here on this fine month of July. So in the last few calls and really in a growing number of meetings we've been spending a lot of time discussing the current market framework, really being indicative of the new secular bull market. What we've discovered over the last 18 months is that there are many catalysts at play in today's market that were simply not at play from the years of 2000 to 2012. Today we're seeing falling correlations, lower VIX levels, lower oil price volatility, falling inflation, and PE expansion. These are current market traits that draw closer parallels to the 1990s, and therefore investors really need to refresh their view of what markets are capable of. In fact, while many have been calling for a considerable market correction, we see an increasing likelihood that markets, especially in the developed world, continue to advance. This past Monday, we sent out a link of David reviewing some of the market correction statistics going back over 40 years, and we hope you found that useful to use with investors. Should you need that link again, please let any member of the team know, and we'll get that to you. So really, to build on these observations, I'll turn it over to Dave, and he can talk about what we're seeing and discuss current positioning and what we see going on from a market leadership perspective and breadth models, et cetera. Dave?
Great. Hey, thanks, folks, for taking the time to tune in today. Beautiful day out there. I'm surprised everybody isn't out of the office already. But we've been busy here at the shop, and as Nick alluded, we are quite constructive on what's going on. So let's just go from the top and just talk about the macro, and then we'll take that and sort of apply it through the portfolios as to what we're doing and where we see things going. Probably first and most importantly, we always ask the question, how is the market behaving? And from our perspective, breadth across the developed world, the consumer-led economies, continues to show very good strength. The percentage of stocks and long-term positive price trends is slowly creeping higher, meaning that more and more money is working its way into equity markets. We are sitting today at about 57%, so 57% of stocks are in long-term positive price trends. That has been slowly grinding higher for a year. Importantly, it is nowhere near the late-stage readings that we get where you get to a point where 70 or 80% of stocks are participating. It's just a very slow, steady grind. So money is getting put to work in the equity asset class, specifically focused in developed markets. Of course, we have to ask the question, why? Well, clearly, if we look at the bond market, we continue to have a very constructive bond market with yields in the 2.5% range, and really no sign that yields are going higher. We'll talk about bonds in a moment, not to say that yields couldn't go higher. We don't think it, at this point, is posing any challenge to equities. If we look at valuation, the equity risk premium, or the comparison between earnings yield and the 10-year yield in a U.S. government bond continues to be very favorable and very strong risk premium supporting money moving continually into equities. We see that flows are coming generally out of fixed income and into equities in the private investor world. When we look at earnings and are they supportive, so far this year, this quarter, 21% of S&P companies have reported their second quarter earnings. It's shaping up to be a very strong one. 77% of companies have beat earnings per share by an average of 7%, and 70% of companies are topping their revenue forecast by an average 1.6%. The revenue upside is what I want to highlight. That is a change, and that is improvement. And we look at earnings estimates going forward. We are seeing earnings estimates hook higher at this point, where over the last 2 to 3 years at this point we were seeing earnings estimates for the year hook lower. From an earnings multiple perspective, multiples are slowly expanding. Now this is confounding for investors because they say, well, earnings growth is X, market is rallying X plus some number. that sum number is being by multiple expansion. It's hard to sometimes discern why that is, but clearly money is being treated better in the equity market than it is in other asset classes. When we look at the economic data coming into summer, we highlighted the fact that when you come into this seasonal period with leading indicators going higher, in 86% of the cases, stocks rallied 5.6% through what is considered to be a seasonally weak period. If you look at the most recent PMIs, the Empire Manufacturing data has improved 3 consecutive quarters. NEHB housing data has improved 3 consecutive quarters, including the July 14th reading. And the Philly Fed has improved in each of the last 3 readings, the mid-July reading coming in considerably better than it did in June. So the economic data and the leading economic indicators are supportive and showing expansion. When we look at breadth around the world, we know that developed markets have been leading, and certainly earnings growth has been more significant in the developed world. Developing markets are behaving better. So as opposed to money working its way out of markets, developed markets continue to outperform but develop a little bit better, which is helpful for some of the more cyclical sectors and more economically sensitive sectors. Breadth is improving, valuation is supportive, PEs are expanding, and finally, correlations, which we've highlighted through a bull market, tend to fall, and as of last week, equity correlations hit fresh new lows for this rally. So when we look at behavior of the market and why things may be behaving this way, both point to continued improvement in equity markets in the current environment. Now, when we look at a sector perspective, this continues to be supportive. We know that 2 of the most important sectors to follow if you expect the economy to slowly get better is semiconductors. Semiconductors we consider to be similar to looking at in the old world copper, because semiconductors go into everything. The Philadelphia Semiconductor Index today hit a new high. Transports Index is trading right back at the highs. That's another important indicator. So both transports and semiconductors behaving well. When we look at key sector themes for us, certainly energy continues to behave well, both infrastructure and producers. Technology continues to improve. The broad technology sector, which includes software and semiconductors, are hitting new highs. Industrials have been behaving extremely well. They've had a sideways consolidation over the last 2 to 3 weeks, look to be turning higher. Financials and consumer discretionary, which had been lagging, are seeing some new net buying, and consumer discretionary over the last few days has been picking up steam and relative strength versus the market, important in consumer-led economies. So we have seen a continuation of the leadership that we had rotated to over the course of this year, and we find these things very supportive. Now, at the portfolio level, the income portfolio, as you know, has had the most significant weight in energy, and it continues to make up a total of about 40% of the portfolio when we put together energy infrastructure and producers. So energy infrastructure, roughly 20% of the portfolio, and producers about 16%. They continue to behave really well. From a dividend growth perspective, again, supportive of equities, it looks as though the S&P is tracking towards a low teens dividend growth rate versus a dividend growth rate last year of 10%. So dividend growth is accelerating, yet the S&P companies are holding record cash levels again. So we are seeing dividend growth. We are seeing share buybacks. We are also seeing M&A activity, which is a good use of capital, and the market is applauding M&A by seeing many stocks who make bids go to premiums to where they were prior to the deals. So behavior continues to be good. We are getting more than our share of dividend growth. On average, our holdings have given us just under 16% dividend growth so far this year. So if we can get 4-ish% cash flow in the portfolio and get dividend growth in the 16% range in a world that is income-starved, we think that continues to look really attractive. Dividend payouts in the S&P continue to be below 35% of earnings, well below the long-run average of 50% payouts, and certainly way below peak payouts, which can come as high as 70%. So dividend growth can come on for a long time. In the makeup of the income portfolios, we have continued to trim our fixed income exposure, not because we think there is risk in the fixed income market, but because we are not getting compensated well for the risk that you take on. Now, let's talk about bonds for a moment. A lot of people questioning with the Fed exiting their quantitative easing, what that means for U.S. bond yields. Does that mean U.S. bond yields go higher? We would make the case that the U.S. bond market is driven by global flows of capital, and there's a simple comparison being made by global fixed income investors. What yield can I get for owning euros, and what yield can I get for owning U.S. dollars? Yield on a German Bund today, 10-year bond, hits new lows, breaking through the lows from last year. 10-year Bund is paying a yield of something like 1.1%. 10-year U.S. government bond, 2.5%. Global flows continue to buy U.S. government-denominated bonds. So while we don't think we get paid well to do it, we think it's very unlikely that U.S. yields work their way higher so long as European yields are working their way lower. The spread, the difference between the two, is just too significant, and that drives demand for U.S. government bonds. Equity markets behaving well, bond market behaving well, risk premium is supportive. The spreads on credit products continues to be very narrow, meaning bond market is not perceiving credit risk. Economic data continues to be strong. Now, we sent out a link yesterday considering the question, have things come so far that we should expect a correction? And I know that it's a common theme with clients, and certainly some of the advisors we talk to, they're afraid to commit fresh capital because looking back over the last 12, 13 years, anytime we went through a strong period as we've been through, we were likely to get some kind of significant correction. As Nick alluded to, and as we've been talking about, we believe we are in a very different kind of environment than we were in over the period from 2000 through 2012, a secular bear market. We believe we're in a secular bull market today. And behavior is very different in a secular bull market. Secular bull market is marked not only by earnings growth, but continual earnings multiple expansion. So in the 1990s, in 8 out of 10 years, you got PE expansion, and that's what we've been going through over the last 18 months. And when you look at the length of rallies in secular bull markets, they're very different than secular bear markets. So lots have been made about the fact S&P's rallied 670 days without a 15% correction. And from our friends at Cornerstone Macro, they gave us a list of the most significant bull markets in history going back to the 1930s. Now, first of all, it's important to note that this, by any stretch of the imagination, has not been a long expansion. If you look at the most significant bull markets, each happened in secular bull markets. So we talked a lot about the bull market in the 50s and 60s, where through that period dividend payouts rose, PEs rose, and dividend growth led the market. It was in a low interest rate environment with low inflation, very similar to the environment we're in today. And in that world, through the 1950s, stocks rallied for 2,100 days without a 15% correction. That's 3 times as long as the current bull market. Wouldn't we feel foolish for exiting a bull market and have it rally for another 2 years with double-digit returns? In the 1990s, secular bull market, PE expansion, earnings growth, dividend payouts higher than they are today, market rallied 1,928 days. Again, 3 times as long as the current bull market. In the 1980s, secular bull market, low interest rate, low growth rate, market rallied 1,306 days. So by no stretch is this market gone to the point where we think that it could come to a natural end, or where you get a 15% correction. Certainly you can get corrections at any time, but it continues to be the case the market has shallow pullbacks, and they come in leading stocks, but there's cash waiting underneath the surface to get allocated that comes in very quickly, and we think the most significant theme in the market is dividend growth. Large cap is best performing part of the market currently, supported by very specific sectors. When we look at the length of the current economic expansion, starting from the point where housing began to recover, current economic expansion has been going on for just about 8 quarters. In the 1990s, the economic expansion lasted 40 quarters, 10 years. In the 1960s, 35 quarters. In the 1980s, 30 quarters. When we look at the factors that are typically at play when it comes time for correction, Cornerstone highlights 9 major factors that have been in place before you had significant corrections, and this goes back to the late 1960s. So the 9 factors include significant rise in oil price, significant Fed policy interest rate hikes, significant increase in long-term interest rates, economic slowdown as evidenced by ISM data, consumer euphoria, consumer sentiment being over 90%, high valuations, financials and consumer discretionary stocks lagging the market, global interest rate tightening, and the 9th factor, international crisis. So, for instance, in the 73-74 bear market, 8 of 9 of those faced before the bear market began. In the bear market leading through 1980 and 81, 8 factors were at play. In fact, if I go down the list, and there's, I think, 11 major corrections, you know, the number of factors at play, 8, 5, 8, 7, 6, 8, 5, 7, 6, 7. Current environment. There may be 3 of 9 that check the boxes, but consumer discretionary is showing a pickup, which means there's 2. And international crisis, I'm not sure we can put the current Middle East crisis on par with the Asian currency crisis or the European debt crisis. So I would say there's a soft 2.5 factors of 9, so they don't argue for correction. So look, we argue that the hardest thing as an investor is to know when to sell. A lot of times that means that people have a hard time taking a loss. We would argue the other difficult thing to do is to hold and continue to buy when things are working. If we start to see changes in our models, or we start to see change in the economic data, or we start to see change in the earnings data, any of these factors start to change, we can reconsider our position. But from the current standpoint, we are virtually fully invested. We think that our sector exposures are good. We think correlation continues to fall, meaning being a targeted manager makes a difference. We will just continue to ask the question, is anything changing? So we would continue to suggest adding to the income portfolio. We would consider adding weighting to the equity strategy. In the 1990s, we had very, very significant outperformance versus the benchmark because correlations fell all the way through the period, and by getting to the right space made a big difference. Technology is a much bigger weight in our equity portfolio given the fact that many of the names have very little by way of yield, and consumer is a bigger weight. NASDAQ is a larger weight in the portfolio, so 50% of our holdings are in the U.S. This is where we stand. We're happy with returns so far, more or less over the course of the year. I think that we're in a good spot. We're certainly going to watch the earnings as we go through the rest of the quarter. But as it stands today, we continue to be quite optimistic and look forward to the next few months. I'm going to pass it back to Nick.
Great. Thanks, Dave. So clearly with this type of information we've been sharing, else that our mandates have yielded through this market shift, we really do feel that the current market is one that suits our market leadership style. You know, while our approach, which really closely tracks breadth, can be increasingly defensive if needed, it's also, as Dave said, an approach that can really find focus in the strongest pockets of a new secular bull market, as we feel we've entered now. And we've said before, and Dave just said, there's really 2 difficult periods for investors. We see this even dealing with private clients. You know, one being, and actually they both relate to managing exposure, you know, holding on to things into a major drawdown like 2008, and the other environment, which is probably more enjoyable, is, you know, where markets continue to advance and investors become nervous over an impending correction. Barometer's approach is well suited to both environments, as was evidenced in the downside we provided in 2008, and our high income pool was down 7%. and our track record through the 90s, as Dave alluded to, where equity results averaged close to 20% a year. That said, we really do remain forever watchful of market breadth, and we take our cues on market exposure from breadth, and that's how it ties into managing our stop losses and our exposure. But as Dave said, market breadth remains constructive, continues to expand at a measured pace, and there's really lots of field room left. A few performance points year to date. Results have been quite good in the environment we're managing within. The Disciplined Leadership High Income Fund, as well as the High Income Pool, closely mirrored results at around 7.8% year to date. Equity results a little stronger, long short up 11.5%. That new equity fund up 10.5%. And we've actually, Sarah and I have been using Morningstar performance links that provide rankings versus our peers that are refreshed daily. And actually the Disciplined Leadership High Income Fund has been consistently ranked over the last number of months, either first in category or second, depending on the day. The one-year return more recently of 16.5%. And that's significant in light of the fact that the transition and leadership changes we've witnessed over the last 18 months in the income. The newer Disciplined Leadership Equity Fund that was launched in January is actually up 10.5%, as I mentioned, and that's actually double the category average, the global equity category at 5.2%. So if you'd like access to those links that allows you to track performance daily, which maybe is a little overkill, but it is available, please ask Sarah or myself. So with that, operator, we'll open it up to questions at this time.